We now move on to our first session, the Changing Wealth Management Canvas in India. To begin this, I would like to invite moderator for this session, Mr. Sunil Singhania. Mr. Singhania is the founder of Abacus Asset Management. Mr. Singhania, the floor is yours.
Thank you, Abhishek. Welcome you all. It's an honor to moderate the first session, and we have a very, very distinguished speaker who is going to start the proceedings in a very, very jestful manner. Amitabh Chaudhry is our first speaker, and I have a really, really long and illustrious description of him, but I'll just try to keep it short. We are in this world of fintech, and we are honored to have someone who's experienced not only on the technology side, but also on the financial side. Besides its other stints, just to highlight, Amitabh was the managing director and CEO of Infosys BPO. And, he was instrumental in building the Infosys BPO practice right from his inception. From there on, Mr. Chaudhry moved to HDFC Life. And in his 9-year stint in HDFC Life, he created the most valuable private insurance company in India. And now, as the managing director and CEO of Axis Bank is undergoing a well-outlined multi-year transformational program. And we are very sure that under his leadership, Axis Bank will catapult itself to being the premier financial institution in the country. So the floor is all yours, Amitabh, and we all look forward to a lot of guidance and words of wisdom from you.
The CFA Society of India for giving me this opportunity and sharing my thoughts with this august audience. When Navneet was reading through the people who are going to be addressing this conference, I felt really out of place because they all seem to be stars in their own field and they understand the space exceedingly well. Let me start with a disclaimer clause. I'm not a wealth management expert. So whatever views which I express here, please take them to heart based on the fact that I'm not an expert as far as wealth management goes. And as luck would have it, when I joined the Zoom call, I saw Sunil wearing a suit, and that immediately perturbed me because I thought I'm not wearing a tie. But I was glad to see Navneet wearing a Nehru jacket. So in my mind, I'm standing right in between a suit and a Nehru jacket. So from a risk perspective, I'm safe. With those words, let me start by giving you an overview of at least what I understand of the Indian wealth landscape over the next few minutes. You can put up the presentation, please. I'll really appreciate it. I've had, when I was thinking through what to speak about in my keynote address, I thought it was very important to kind of set the tone in terms of where we stand, what some of the numbers are, and how the numbers have panned out over a period of time. I still can't see the presentation up, so I'll just give it another couple of minutes, but let me just continue in the meantime. Ever since the global financial crisis of 2009, the global wealth has grown almost at the rate of about 5% per annum, from somewhere around US dollars, just a second, from about US dollars 227 trillion in 2009 to 361 trillion in 2019. Yeah, the presentation is up, that's great. And interestingly, the wealth in the US has grown at a faster pace, or at 7% per annum over this period, while in case of China, as expected, the growth rate has been over 12% per annum. The point to note here is that in spite of the world going through a severe economic crisis during these last 10 years, the growth rate of the wealth management business has continued at a pretty decent pace. We should also realize that the savings rate in some of the economies around the world has obviously grown at a faster pace. So for example, China has seen a savings rate of 25% against, say, 10% for US and Europe. At US dollar 12 trillion, India accounts for just 3% of the global wealth. Our GDP today stands at about 3.2 trillion on nominal basis against a global GDP of about 87 trillion. So if you look at our proportion of our the wealth management business and compare it to the share of GDP, I think we are a tad lower on the overall proportion of wealth. But you can also see at the same time that US's share of global wealth is disproportionate towards GDP, which in my mind reflects the global nature of the wealth of its citizens and how expansive the US has been over the last 60 to 80 years. Uh, but however, if you look at the profitability pool of the business, of the wealth management business, and I read some data, the profitability pool has remained in the 130 to 140 billion dollar range over these last 10 years, which very obviously clearly indicates the rising competitive intensity and the increased sophistication of the clients during this period. If you change the slide, please. And now this just outlines the number of individuals above a certain wealth range. So while US has really 6 million individuals who may be qualified as high net worth, and the corresponding number in China is 1.3 million, the number of high net worth individuals in India is just over 263,000. The population of ultra high net worth individuals seems to indicate that the gap between India and China, or say India and US, is narrower. So that means in proportion, again, we seem to have a decent number of ultra high net worth individuals. Another interesting data point, which I thought I should share with you, is that when people analyze the top performers in the wealth management business, actually they had fewer number of relationships than the average wealth managers. They had more accounts per family, and of course they had lesser attrition, which again I think points to a fact that trust and mining of your existing accounts seem to be very important factors in this business. Next slide, please. So the question that comes immediately to the mind is, where is this wealth invested? The chart on the left shows how the asset allocation of the Indian high net worth individual is positioned across asset classes vis-a-vis the global high net worth individuals. You will observe that the average Indian HNI is considerably underweight on equities and debt, I think which all of us know, while he is overweight on alternates and real estate as compared to his global counterpart. This is not surprising, and we have conventionally been over-allocated to physical assets versus financial assets. What is notable, however, is the change in this trend over the past few years, where obviously the allocation seems to be changing slowly and gradually in the direction of what you see globally. Now, very quickly, let me move to a couple of emerging themes which I envisage are taking shape, especially in the post-COVID era. Navneet talked about some of those changes, some of the challenges which the wealth managers of today are facing, and how they're making those portfolio choices. Navneet mentioned regulatory changes. So obviously regulatory changes have been and are likely to continue to be quite seismic in favor of increased transparency and improved governance. Wealth management is not the only one going through it. Every industry across the world, regulators, wherever regulators are involved, regulators are pushing more transparency, more open architecture, more governance, and in many cases they are pushing that governance down in a much more sophisticated and significant manner than what they've done in the past. We have already seen some landmark changes happen in India also, and they go back all the way to 2009 when entry loads were abolished for all types of mutual funds schemes, to 2020 when fees payable on PMS schemes have been moved to an all-trail model. The interesting part is the impact of these regulatory changes has not been restricted to only the equity and fixed income asset classes, but have even encompassed asset classes like real estate with the implementation of RERA and other products like insurance. So this change is global. This change is coming to India. India is adopting these changes in a much faster fashion than what has happened in some of the other global markets, and we as wealth managers should be prepared for it. If you go to slide 6, we know, and the slide on the chart on the left-hand side shows what the wealth managers feel will be the impact of technology, and what do they believe are the factors which will impact the wealth management business going forward. So we know that the impact of technology cannot be ignored, with big tech, fintech, and all kinds of solutions coming up. Wealth managers obviously will need to embrace these technologies like biometrics, chatbots, cloud computing, artificial intelligence, algorithms, robots, so on and so forth. And they need to offer these solutions to their clients because their clients are aware of what exactly is going on in this space. If you move to the next slide, all of us are aware that environment, societal, and governance has been a key theme for high net worth investors over the last few years. $282 billion, as the slide indicates, was invested through clean energy investment. We also see the younger set of HNIs who want their portfolio to be tilted towards sustainable investing. So you can expect alternate energy, renewable energy, and clean technology no longer as thematic investments. They are going to become an integral part of what your clients would be expecting from you. And they're moving towards the core of every high net worth investor's portfolio. If you move to the next slide, it very quickly talks about, for example, Boston Consulting Group in a study shows that about 45% of the wealth managers' income globally is fee-based. And at 14%, this number in India is incredibly low. So you would expect and should expect that we will continue to move towards more a fee-based income profile. And we have to ask ourselves whether we are prepared for it. Globally, this number also has been rising steadily in the past few years, and we should expect the same to happen in India. The revenue mix is also likely to change, with a large number expected to be delivered through an advisory-led fees model. So after giving you this context, I think it is very, very important to do some kind of crystal ball gazing and talk about, at least from my perspective, what the future for the wealth managers could look like. We have slide 9. We have seen two massive crises over the past decade or so. And these crises have moderated global growth and have reset the equilibrium for financial markets globally. As an aftermath of these crises, regulations have become stricter and they have resulted in increased compliance across the board. Actually, post every crisis, what we have seen is that the level of regulations, the level of interventions increase manifold. Of course, these crises have also created a playbook which now drives government and central bank responses in extreme situations. So what you're seeing today in a COVID crisis, part of it is the playbook which they have used in previous crises. So I do believe that the COVID-19 crisis, we'll see a similar playbook, but the only difference this time is that it has led to severe economic dislocation. And in many cases, the government has been forced, or the regulators have been forced to take decisions on the fly. And at the same time, because of the severity of this crisis, there are limits to what the government and the central banks and the other regulators can do. One thing which has definitely emerged, the next slide, from this crisis is that it has led central banks to create unprecedented levels of liquidity. India is no different. This liquidity has found its way into most asset classes all over the world. As we have seen, even the legendary investor Warren Buffett, who had made statements to the effect that, he cannot understand gold as an asset class. Gold as an asset class is dug from the ground, melted, and then we reburied in the ground and then have people guard it. That statement has always remained in my mind. He recently went and invested in gold mining stocks. So we are already, also seeing negative interest rates globally with the increased liquidity pumped by central banks. This phase of zero or near zero interest rates is also likely to get extended. Equity markets, not just in the US, but even in emerging markets like India, are now just a shade below their all-time highs. Actually, you have regulators who are trying to play down the stock market. So I don't know whether it is exuberance or irrational exuberance, but this excessive liquidity in the system definitely inflates the prices of assets globally, and India will not be far behind. So if you go to the next slide, and let's talk a little bit about what we can expect to happen and how some of these things will play out. Let me raise a more logical question on everyone's mind. What will the future of wealth management be? What should the priorities of wealth managers should be in the future? My belief is, where I come from, I have worked in technology companies, in the next decade or so, the real question before a wealth manager is that in the next decade or so, tens of billions of connected devices will likely churn out huge amounts of data. So huge amounts of data will be flowing between all of us and through our devices. And we will have, all of us, will have dizzying number of apps or algorithms on our phones or machines at homes and workplaces which will spit out recommendations that exceed human cognition. You will have advices coming out of your phones and devices, dime and dozens every second. I think Navneet mentioned that, yes, there is a lot of advice out there. Clients will have more knowledge at their fingertips than ever before. But the problem is that they will not know what to do with those insights. And what do those insights mean? Because more is the apps you have, more is the recommendations you have in front of you, more are the differences between them. And they will also have infinite options in terms of how they deploy their wealth, because the same technology will allow us to commoditize these options and sell them globally. Just to give you an example of the mobile-based wealth manager in China, Lufax, it has 5,000 products available on their mobile app. How does a customer even go and choose a product there? So you have infinite amounts of information available to you on your fingertips. Everyone claims that their algorithm works, and in some cases they do. And you are a wealth manager who does not like the customer, does not know which app to go for, what information to read, what information to filter, and then ultimately what to advise to your customer. So this paradox of an information-rich and option-rich society will be the poverty of time available to make sense of all the information on hand and how to make those decisions. So on one side, too much information, too many options. On the other side, limited time and limited ability and capability to go through those options and make decisions about what to do with your wealth. And that, in my mind, it will be the key test of the wealth managers going forward. How do you make sense of all this information? How do you make those recommendations? Which options you look at? And how do you go about advising your client? How do you present these options to the clients, which were, by the way, because there are so many options available which are not available earlier, because they were prohibitive earlier. But at the same time, you guide your customer to the right solution. So wealth management, in my mind, has been a personalized business, but I expect the focus to move to hyper-personalization with increased orientation towards individual client preferences, driving the way wealth managers engage with their clients. So the only difference or differentiator you would have is that you are well-read, you know what is happening in the world, you have a view on what is happening in the world, you present various options to your clients, and based on their context, you actually guide them towards taking the right decision. You need to know, you need exceptional levels of learnability, and you need to distill information and make the decision making simple. Not an easy job. You have also already seen client engagement moving to virtual platforms, but increasingly client servicing will also become entirely digital. So while technology will reduce the need for wealth managers, because a lot of what you do today is servicing, the ones who will be left will need to prove their value through their close nature of the relationship and the extensive information which you have on your individual clients, their environment and their context, so that you can give them the right amount of advice. Please also understand that in the future, more and more wealth will be in the hands of women. All of us are too used to selling our solutions to men. Women will become a very integral part of where the wealth lies. And I don't know, and I don't think a lot of wealth managers are prepared for it. And also for the younger generation who will become wealthier tomorrow, wealth won't just be about money. It will also be about meaning, purpose, connection, and making a positive difference in the world. It will also mean giving access to asset classes which was not possible before. In summary, what I'm really saying is that the interplay between needs of a customer, the interactions you have with the customer, and the kind of services and solutions you provide to the customer will undergo a massive change. And as this transformation happens, as a wealth manager, you have to be prepared for it. Finally, the impact on revenue and costs can't be ignored. While I'm sure you already agree that it is being felt, on one hand, the margins are coming under regulatory pressure, and the gravitation towards advisory platforms, as I mentioned earlier, is speeding up the margin compression. Hence, focus on bespoke solutions, performance-based or value-based pricing will become important. By the way, COVID will add to this problem. In the last global financial crisis, the pricing on wealth management services fell quite a bit, anywhere between 25 to 30%. And post the crisis, the price settled somewhere between the lower price and the kind of pre-COVID price. So you never got the price which you were charging before the crisis. Same thing will happen post-COVID. So be prepared for lower margins. At the same time, focus on costs is also going to increase. Costs will therefore need to be managed in a macroscopic way if one has to maintain the cost-income ratios, especially the kind of cost-income ratios wealth managers have enjoyed in the past. Some other trends, very quickly, just hitting them. I do believe the bigger players will become bigger. So we will see organizations that can deliver multi-jurisdictional, multi-capability, multi-time zone service. But at the same time, you will see niche players that can charge a premium for specialized expertise. The middle will get squeezed out. And my belief also is, based on what I'm seeing in banking, what I saw in other organizations I've worked in, that the larger organizations will expand further by creating ecosystems. So not only will they provide a lot of end-to-end services, but they will keep on adding partners and create an ecosystem where their customers don't even have to go outside their ecosystem to look for any service. My other view is that the retail banks and mutual funds will continue to commoditize parts of what typically a wealth manager does. So what you think niche today is going to be commodity of tomorrow. Be prepared for that. Tech companies see this as a juicy play, and financial is a good example. I mentioned Lufax to you. I do believe technology players will increasingly come into the space and commoditize parts of it. I also believe that the user ratings, like what you see in Uber, could become a norm in the future. So unless you do a good job and your user ratings are not good enough, people will not come to you. So let me kind of, I was given 20 minutes. Let me try to wrap it up quickly. Let me give you some highlights on some of the golden route for wealth managers. We have tried to put some, kind of interesting cartoons here very quickly. Client profiling remains extremely important. Without getting into complete granularity of the client profiling, you cannot be successful. This has been a time-tested approach for wealth managers and will continue to remain so. Diversification, not just within, but outside the borders of the country, across asset classes, and even currencies is what will be important for aiming towards predictable performance of portfolios. I think we all tend to ignore risk management, especially when we are all in the bull markets. I think I heard about a session about which is going to be taken on risk, and Lou was trying to sell a book to you. So I think risk management is extremely important. As I mentioned earlier, wealth managers obviously need to keep an eye on cost. If we move on to the next slide, we spoke about technology, and this cannot be overemphasized, as this is the new normal. The manner in which we used to engage with and service clients will now need to be entirely technology based. So you need the platforms, you need a seamless experience, and you obviously need to move with the times. No one likes paying taxes, but without using measures like these, how should wealth managers plan to optimize their clients' tax impact will become even more critical going forward. We also have to be careful here. You don't want to come up with tax saving exercises which can ultimately hurt the client because the tax authorities come after it. As the man says in the cartoon, like cholesterol, there is a good leverage and a bad leverage. Understanding when and in what magnitude to employ leverage will become one of the key challenges for wealth managers as we move forward. And finally, while we review and rebalance portfolios, which sounds like the simplest thing to do, but in practice is the most difficult approach to follow, is something which wealth managers will have to perform religiously. They need to keep rebalancing and reviewing their portfolios. Let me move on to the next slide. We are in COVID times. What are some of the things we should be thinking about? We need to be seeing this as an opportunity, not as a crisis. I'm sure your client portfolios are going through what they're going through, and maybe your performance is not looking good. I think what you have to sell to them is that it could have been worse. Because you were there, because you gave the right advice, it is in spite of this unexpected, one of the most severe shocks which this world has seen, their portfolio is looking not as bad. So I think you should play from the front foot. My view is use this time to prove your mettle. Forecasting in the short term is wrought with risk. For instance, who could have predicted that gold will be one of the best performing asset classes a year ago? So it is important that you walk them through some of the decisions you took for them, which have worked. play tactically. So in these times when things are so volatile, so uncertain, people using the word radical uncertainty, I think it is important to be tactful too and be willing to make changes where necessary. If Warren Buffett can go and change his philosophy, which he has espoused forever, I'm sure we can also look at tactfully rebalancing our portfolios. Finally, be prepared for changing business models. High net worth clients are becoming increasingly averse to fixed fees and asset-based structures. They talk to each other a lot. Family offices have been formed. There are various forums where they hear about ideas. They're calling people where all kinds of ideas are given. I think we should be open to new business models. We should be willing to learn. We should be willing to listen. We should be well read, so that when new ideas are put before us, we should be willing to either embrace them or be willing to have a discussion with them. I represent Axis Bank, so it will not be fair on my part not to complete my address without talking about our case study of Burgundy, our wealth management business. We, on slide 15, Burgundy has modeled itself on 3 I's: integrity, intellect, and innovation, which combined in equal measure has helped us to grow our assets under management at a staggering rate of actually 23% per annum. And over the last 3 years, we have now reached a level of 155,000 crores. Through this times, we have witnessed numerous challenges, but our focus has been on ensuring we do the right by our clients, leverage our intellectual capabilities, and provide compelling and efficient solutions, which has helped us build an enviable franchise in the wealth management business in India. The only thing which has helped me, and I do want to thank everyone, when I've read about this business a little bit more, my only question I'm asking myself is, why have we as an institution not done more? We should be doing more in this business. So I'm sure you can expect to hear more from Axis in this business and what we'll do as we move forward. Thank you so much. Let me just end here, and Sunil, maybe open it up to questions. Sunil,
we do have a few questions from the participants, but just to kickstart,
Sunil, I can't hear you very well. Maybe I don't
mention
know.
About the big opportunity in India. You also mentioned the diversity now. Oh, can you hear me now? Am I audible now?
Yeah, you are audible now. Yes.
Mr. Chaudhry, I'm audible now?
Yes, you are. Yes, you are.
Okay.
I can see you also.
You did mention about the big opportunity. Yeah. Opportunity in India, with going to increase. And we're also seeing families with the regulatory environment has from value perspective, what would be the 3-4 things other than what in the slide?
I can't hear you. If someone else can repeat it, but somehow I can't hear you.
3-4 things they should be the whole space.
Sunil, I think no one can hear you very well. If someone else, I don't know if you can type the question. There's a lot of static on your line. If you can just type the question, maybe somewhere I can then answer it. I just heard 3-4 value and answers. I can try to guess the question which Sunil asked, which I think he was talking about 3 to 4 value enhancers or things which can add value over a period of time. I don't know whether he was talking about the asset classes or he was talking about from a wealth manager perspective. My view on any business which we are undertaking in India, especially from a wealth manager individual perspective, is yeah, okay. I have got at least one part of the question, but let me just cover it. Is that the biggest drawback which all of us have as individuals when we work in any industry is that we don't work hard enough to learn more about what's happening around the world and what's happening around us. We limit our learnability on whatever we do, be it technology, be it global trends, be it what's happening, in the other markets. I don't think we read enough, we study enough, and that's where we end up doing the same things all over and over again, and we hope that somehow the output will be different. So that'll be one important thing. Some of the other questions which have come is, are the markets due for a big correction? Well, I do believe that the reason why markets are behaving the way they are behaving is firstly is because of liquidity. I think one thing which is different about this crisis is that people do believe that there is a definite end date or expiry date to this corona crisis. With 20 vaccines, in the works, people do believe that in the next couple of quarters, at least 2 or 3 vaccines will become available, which will be effective. And once they start becoming available to the larger population, the anxiety which people have will go away, and then the economy could come rebounding back. So I think one big difference in comparison to the global financial crisis, where no end seemed to be in sight, here at least there seems to be an expiry date. Not very clear, but hopefully it will happen. And so I do believe that, yes, the market seems to be getting ahead of itself, but it is getting ahead of itself because of this reason. Whether it will correct or not, I'm the last person to predict it, but I do believe that there is that small difference we should be aware of. Someone is asking me, is Axis Wealth Management focused on fee-based wealth management? Well, that's a choice which Axis Wealth Management needs to make, and that's something which I should not be talking about in a conference of this nature. But I do want to say that Axis Axis Mutual Fund has done an incredible job over the last 2 years, and that is reflected in their rankings. And I do hope they continue to move forward in this regard as time goes by. I do believe Indians should get exposure to global assets. I think RBI has allowed it. I don't think we as a financial system really done enough work on selling the right kind of global assets to our clients. I think we have hesitated to do that. And because we are hesitant to do that, the Indian customer is obviously not willing to invest in global asset classes. India has a lot of wealth. It is growing. And it is important that we diversify that wealth in the form of global asset classes. I'm seeing a lot of mutual funds which have started pushing it, but I think the wealth managers have to play a bigger role in this as we move forward. Sunil, if you have perfect Wi-Fi, you can continue to ask. Otherwise,
Hi, I'm here. Can you hear me now?
Yeah, it is better. I hope that it continues.
I'm very sorry, I don't know what happened. So anyway, coming to the question, there are a few questions that interest rates have fallen dramatically in India. And earlier, when we used to talk about savings, the general perspective was that you save 1 crore of rupees and, you get 1 lakh rupees a month. What happens now? What would you advise? Because we don't have a very robust social security system in India.
No, it is a question which is being asked by a lot of people who have planned their retirement based on some of these very principles. That they thought that a certain corpus will be good enough for them to manage their life post-retirement, and that has obviously been put under great stress because of this. I do believe that we are reaching the fag end of interest rate cuts. I think yes, RBI still has something left in the armory, but I think we are coming to a fag end of that. But it just goes to show that, and by the way, when I used to work in insurance, the same fact used to apply, that you have rising costs of health, you have new diseases which all of us are acquiring, and COVID is a great example of how something can come and hit us completely from the side which you never expected. And the interest rates And with the kind of excess liquidity in the system and the way interest rates are, you might not be able to earn the kind of returns that you were expecting. Which just goes to show that I think we need to save more. We need to save more for the future or plan our lives even better. Now, and that's where the role of wealth management comes in. I think all of us, a lot of the consumers out there believe that they know how to manage their wealth. But if the wealth managers can really go and sell their services well, I think they need that service to be able to plan their life. A lot of us don't do that. Neither do we spend enough time, nor we really look and plan our retirements very, very well. Obviously, the deposit rates are reflect, where the RBI is taking them, and they're taking them there because they want the borrowing rates to come down. I think this is the new normal. I don't think ever you will see the 10 to 12% rates come back, because the world governments and the world regulators have seen that even if you pump in excess liquidity, you can manage inflation. You can. You might not, but you can. And that has been proved in the past. So I think they will use this playbook again and again going forward in the future. So if that is accepted, then I don't think you will see those kind of 1 lakh rupee of interest coming on 1 crore deposit every month.
Right. And you did mention about technology, and you also intertwined it with the young the young people who have started to generate a lot of wealth. Now, when we look at both, I think the way the youngsters think is very different. When people my age or senior, or from anywhere between 35 to 60 years they think about putting some money in fixed deposits or some bond fund, some money in equity, some money in real estate. But the youngsters are very different. They want high risk, they want some startups, they are open to investing overseas. When I speak to my kids, what stocks they would like to buy, they always talk about Netflix and Facebook. They never talk about the Indian make the wealth managers aware of so many things. It's going to be very tough, right?
Oh, it is going to be very, very tough. I mean, today, our kids of today are global citizens. They're no longer, they are citizens of a country, but kind of education which is being provided, kind of information they have available on their fingertips. They know what's happening in the world. And by the way, they have, in many cases, firm views about what is right, what is wrong, what should be done, what should not be done. It might be wrong, but they have firm views. So unless we are able to cater to them and provide them, and by the way, they want Amazon-like experience in everything. It's no longer that, they want only Amazon-like experience when they're buying from Amazon. They expect a bank, they expect a wealth manager, they expect an insurance company to provide the same experience. And if you don't, you're out of their list. So the new wealth, when it goes to some of these people, if you are not prepared for it from a technology, knowledge, engagement perspective, you will be thrown out quite quickly. And once you are thrown out, because all of us are living, all these kids are living in an interconnected world, it will spread also as quickly that you don't get it. So right. the world is, it is going to be tough to manage the business going forward. Yes.
Right. The recent proposed IPO of Ant Financial is being talked about a lot, and I have got so many messages of their presentation, and they seem to be getting ready to do everything. Banking, wealth management, asset management. You have a wide experience on the technology front, and Axis Bank itself has been doing a lot on the technology front. You think that these kind of institutions would be a big risk to the complete financial system? Like they have money to burn and they are here to burn. We look at profits across the board. So, and how to withstand that?
No, so China is definitely the place which has led to germination of all these closed-ended large ecosystems, Alibaba and Tencent, Ping An to some extent. And frankly, then you see the global majors like Facebook and Google and Amazons of the world trying to become large ecosystems in themselves. In India, you see an example in the form of Reliance Jio, and look at the line of people who are standing outside Reliance Jio to invest in them. So ecosystems do have a network effect. Ecosystems can attract much larger set of people, and The best part is because everything is available within the ecosystem, people don't tend to go out. So you do get, if you're part of the ecosystem, you do tend to do very, very well. Yes, these ecosystems do carry risks, risks in terms of that there is too much of reliance on them, that they drown out the competition in a very big way. As you just pointed out, they can spend money to an extent where, because they are valued so highly, they can go and attack the tail to the last mile. See, a lot of the businesses, the traditional businesses, never look at the tail because it's just too prohibitively expensive to attack the tail.
Sure.
In case of large ecosystems, they can attack the last person in the end of the tail and try to attract even that customer, because they can provide, either they're willing to burn money, or because their platforms, which don't cost anything incrementally, they can reach the people at the end of the tail. So in many cases, either you are part of the ecosystem, or you create the ecosystem, or you run the risk of becoming a niche player over a period of time. So yes, you are seeing emergence of these ecosystems across the world. And that's why in India, there is increasing noise as to India does not have its own ecosystems, because we have allowed foreign companies to come and take over parts of those ecosystems. So no localized ecosystem is developed. I think you're seeing Reliance Jio trying to develop one such ecosystem as you move forward.
But that's a chicken and egg situation, right? We all as investors want the government to be more and more liberal. And now when the government has become more liberal, we are going back and saying you have become too liberal. Because, China has the ants of the world and 10 cents of the world, and India has nothing.
Absolutely right. And, by the way, some of the people who are saying that we should become closed are the ones who also have a large amount of foreign investment. So,
right.
but that's been true in India all the while, right? Once you're inside, you don't want anyone else to enter.
Right.
As long as
one last question, wealth managers obviously are bearing the brunt. When they invest and the markets fall, they are hauled for it. When they don't invest and the markets go up, they are again hauled for it. And there can never be the right, answer to it. I think this rally, which we have seen, the massive 4-5 month rally, I would say it's the most hated rally of all times. A lot of investors, particularly on the high net worth and ultra high net worth side, have been underinvested. A lot of wealth managers, relationship managers have advised caution, and they are seeing now this rally going through the roof. And maybe it's running ahead of fundamentals. How do you, as a leader, keep your composure in volatile times, and what would be your advice to the wealth managers in terms of keeping their composure in such times? Because there's always a risk that you might throw in the towel, and at the peak you actually doublify or mistake.
So I have a couple of things I'd like to say. One is that during these COVID times, I know I have tried to reach out to a large number of our corporate relationships. And one thing which I saw when I reached out to them and said, I'm just calling to just offer our services, and we are there. If you need anything, we are available. Not that they needed anything. Just the fact that I was there, just the fact that we called and bothered to call, I was just amazed by the responses, where people said, well, no one has, not that I needed the call, but the fact that you called, I appreciate it. So I think one is that we need to be in touch with our clients, constantly in touch with our clients. So through this rally, if the constant conversations have happened, maybe the client has, blamed, so-called blamed inverted commas, the wealth manager to a lesser extent, because constant conversations have happened. And in those conversations, this rally has also been discussed. Second, obviously, it all depends on trust. I think when someone advises caution, they advise it for the right reasons. And if that trust is there, I think the people will believe that, yes, maybe they missed this rally, but finally, given these times, I think risk aversion is important, and to conserve, whatever assets you have is extremely important. Because, by the way, India is not done with COVID crisis. There will be still enough opportunities out there where you will get your opportunity to invest in the companies which are going to suffer as we go through this crisis further. So I do believe.
So basically, be patient.
You have to
I think we can go on and on. We can go on and on, but we have a hard stop. It was
the trust relationship. I think at the end of the day, customer might still scream at you, but they will appreciate you. Sunil, I think you have frozen again.
No, it was great having you, Mr. Chaudhry. And but thanks a lot for kickstarting this wonderful wealth management conference. And really, thank you. Over to you, Abhishek.
Thanks a lot. Thanks a lot for inviting me. Really appreciate it.
Thank you. Thank you so much, Mr. Chaudhry and Mr. Singhania, for sharing your insights